Hi, welcome to accounting. Today we're going to talk about different depreciation methods. We're going to talk about straight line depreciation, double declining, sum of the year's digits, and units of production. So those are the methods that we are going to focus on today. First, we're going to start with straight line depreciation. Straight line depreciation is the easiest. Most students do learn it in Financial Accounting 1. In straight line depreciation, we take historical cost, we subtract the salvage value, and we divide by useful life. Here you can see we have some facts about the piece of equipment that we are going to depreciate over using all the different methods. And we have here historical cost of $25,000. So again, historical cost means that's the price we paid for it after including everything that we needed to include to get it ready for use, including insurance, freight, any shipping and handling, all that kind of stuff. So $25,000 is our historical cost. We're going to subtract salvage. You can see our salvage here is $5,000, so $25,000 minus $5,000. Salvage value, again, means how much we think that we can sell it for or get for it through scrap at the end of its useful life. And we're going to take that number and we are going to divide it by useful life. Our useful life here is 5 years. That's management's estimate of how long they think that the asset will be used in business. They can make their own estimate or they can use the IRS tax classifications. However, for tax purposes, they must use the IRS tax classifications. For generally accepted accounting principles, they can use an estimate of whatever they choose. So now I'm going to divide my historical cost minus the salvage and divide it by the useful life here, 5 years. And we're going to have depreciation of $4,000 per year. Remember that my journal entry would be a debit to depreciation expense, and that my credit would be to accumulated depreciation, which again is a contra asset account that we use because we don't want to change the historical cost value of the asset account equipment. So again, that would be depreciation expense of $4,000 and accumulated depreciation of $4,000, and we would make this every year for the next 5 years regarding this asset equipment, and that wouldn't change. What we're going to do is we're going to scroll down and look at the same asset, but we're going to use a different method of depreciation. So I'm going to hide all of that so we don't have it in our screen. And we're going to talk about the double declining method. The double declining method is based on taking straight line depreciation and doubling it. So we have a little formula here that shows 100% divided by useful life. And this essentially will we'll find out the percent for every month. So for ours, we'll take 100 or 100%. So that's the number 1. And we will divide it by the number of our years in our useful life, which is 5. So you do a little formula here. So it would be 1 divided by 5 years, 1 standing for 1% or 100%, and we would get 20%. So we'll show that there. And I can show this 1 as a percent too. 1 is equal to 100%. So we would get 20%. But because this method is the double declining, emphasis here on the double, we're actually going to double that 20%. So instead of using 20%, we're going to multiply it by 2 or double it. So we're going to say 20% times 2, and we're going to use 40%. So what you can see here is I have a little grid set up so that we can do the work. For the rate, I'm going to use the 40%, remembering that we calculated that to be our double declining amount. So I'll just kind of take a arrow here and we'll say that's the rate. So I'm going to go ahead and pop 40% in for each year quickly. The next thing we talk about is our beginning book value. So we have to talk about our beginning book value, remembering that book value is our historical cost minus accumulated depreciation. So that's our item is by accumulated depreciation. So we're going to take our beginning book value. So we're going to take our beginning book value, which in our instance is going to be the 25,000 because it's never been depreciated before. So we're going to put in the 25,000. And this method does ignore salvage value until we get to the end. When we get to the end, we will take a look at salvage value. But for right now, we'll ignore it. So we'll put in $25,000. And we have our rate of 40%, and we need to calculate depreciation for the year. So what we're going to do is we're going to say 40% times our beginning book value of 25,000, and we're going to get $10,000 for the year. Now, our depreciation to date is just going to be the same $10,000 because it's the first year we're depreciating it. In future years, that'll change. So now my book value again is depreciation less my book value is historical cost less accumulated depreciation. So we're going to say that this is equal to 25,000 minus depreciation to date. So we'll just subtract that there. So now we have 15,000, and again for depreciation for the year, we're going to multiply it times 40%. So we're going to say 15,000 times 40%, and we're going to get $6,000. So now I'm going to come over here and I'm going to say last year's depreciation to date plus the current depreciation is going to give me my new depreciation to date. Then I'm going to come over here too. So my book value was 15,000 and we have depreciated more. So I'm going to say the 25,000 less depreciation to date will give me my book value. And now I'm going to copy this formula here, which is 40% times the book value, and we'll get 3,600. And I'm going to copy this formula too. I'm just going to go ahead and copy it down. So we're adding 10,000 plus 6,000 plus 3,006 is going to give me my 19,006. So for year 4, I'm going to say 25,000 beginning historical cost minus depreciation to date, accumulated depreciation, 5,400. And then I'm going to copy these formulas and paste them on in. Again, taking 4.4% or 0.4 or 40% times 5,400, getting the 21,600 and adding it up. Now, we know that our salvage value was $5,000, so we can't go below $20,000. So in year 5, instead of multiplying it all out and taking the final depreciation, the most we can take is 20,000 minus, well, let's do it the other way. So it'll be equal to 21,760 minus our 20,000. And 1,760. So that's the most depreciation we can take for the final year because we don't want to go beyond 5,000, which would be salvage value. So our depreciation to date would be 20,000. So if I'll just copy this formula down. Oops. So you can see that we're not depreciating beyond our $20,000 there for our double declining method, and in year 5 we'll take into account salvage value. So now we're going to look at some of the year's digits, and we are going to follow the rule for sum of year's digits, which means that we create a fraction here using the sum of the digits. And if I look here, I'm going to sum my digits. So year 1, year 2, year 3, year 4, year 5. There are 5 years in my useful life. I'm going to sum them. That's why it means sum of the year's digits. So I'm going to add them up, sum them up. 1 plus 2 plus 3 plus 4 plus 5 is going to give me 15. So that is the sum of my digits. And then I'm going to create a fraction. In year 1, I'm going to say 5 divided by 15. I want to show this as a fraction. So we'll say equals 5 divided by 15. It'll give us, we want to show this as a year for some reason. We'll go ahead and change the formatting here. And make sure that they know we want it to be a number. There we go. And then in year 2, we're going to say it's equal to 4 divided by 15. In year 3, it'll be the same, 3 divided by 15. In year 4, it'll be equal to 2 divided by 15. And in year 5, it'll be equal to 1 divided by 15. Noticing that we have much more depreciation in the beginning than we do at the end. Oh, I didn't put a 1 in there. There we go. So we want to do 5/15ths first. See how we have it here? 5 divided by 15, that's our fraction. And then 4 goes opposite. And then 3, and then 2, and then 1. So more depreciation in the early years, less depreciation in the later years. And then we're going to use cost minus salvage. So remember that we had $25,000 as our historical cost. And we can scroll back up and see that here our historical cost is $25,000 minus our salvage of $5,000. Gives us $20,000. We'll put some commas in so that you can see the $20,000. And then we're going to figure out the depreciation for the year. And the way we'll do that is we'll multiply the $20,000 by the fraction 5/15ths. You can see here we're getting a percent here, a decimal amount. So we'll multiply 20,000 times our fraction. And it'll give us 66,666.67. We don't really have to change our cost minus salvage, so I'm going to go ahead and copy it now. We'll just copy it down for all the years, and we'll paste. And then we'll do the same thing. We'll multiply our 20,000 times our fraction for the year, and in this instance we'll get $533.33 of depreciation. And I'm going to go ahead and copy this formula on down so you can see what happens in each year. And that is how we get the depreciation for the year, by adding those up. Very good. So hopefully some of the year's digits is good for you. Most students get mostly confused by adding up those years and getting that digit, but that's how you do it. Just 1 plus 2 plus 3 plus 4 plus 5. If you had more years going on up to 20, 30 years, you just keep on adding. Our last instance is units of production. I'm just going to go ahead and hide some of year's digits so that we can still see our facts at the top. But for units of production, we focus on how much production is being made. So thinking that it's probably the best for our matching principle. When we think about depreciation, we do matching. We want to match expense with the revenue it would help to generate. This is probably the best one because we're thinking about how much the equipment is producing. Some assets you can do this for quite easily. Equipment, usually you can track production. Cars, you can track mileage. But other things like chairs, it may be more difficult to actually figure out how many times someone has sat in a chair. You don't have a ticker to keep track of that. But things like equipment and vehicles, this works very well. So the first thing we want to do is take historical cost minus salvage, which is 20,000. And then we want to divide it by the units that are produced for the useful life. So here we have estimated that we will produce 1 million widgets with our piece of equipment. So we will take 20,000, put some commas in here to make it easier for you to see, and we will divide it by 1 million. $1 million. And so when I divide 20,000 by 1 million, we will say that we can depreciate 2 cents for every widget produced. So in the current year, we produced 250,000 widgets. So we would say 250,000 widgets times 2 cents a widget in depreciation would give me depreciation for that year of $5,000. So again, it's going to be the number of widgets times the depreciation per widget, and we would get 2 cents per widget, and you get $5,000 in depreciation for the year. And again, our